I'm Sonali Basak. I'm the Chief Investment Strategist at iCapital. Welcome to our latest on our series on model portfolios. Today, I'm joined by Alexandra Wilson-Elizondo. She's the Global Co-Head and Co-Chief Investment Officer for Multi-Asset Solutions at Goldman Sachs. Alexandra, thank you for joining us here today. It's interesting, in model portfolios, you have seen how these have been developed across public and private markets. How does this really start to answer a lot of the questions from investors around how 60/40 is changing that traditional portfolio?
Well, thank you so much for having me. It's a pleasure to see you again. The way we think about the 60/40 portfolio is that it's a benchmark, meaning that it's a common language in order to understand the risk profile based on historical correlations of asset classes. We, within multi-asset solutions, have never allocated just based off of the benchmark. We think about building a better total portfolio solution based off of factors that we've analyzed throughout history and exposures that we want. And obviously, alternatives have had a lot of time in the limelight as of late, but for really good reasons. And that's because they can increase portfolio return and diversification at the same time. Obviously, there's considerations that are really important, like liquidity, for example. And so, whether you're optimizing for income and including private credit, or you're optimizing for a 60/40 portfolio, better version of it, if you will, there's been a real evolution in how you should think about allocating, but not just to equity and fixed income in public markets. And one of the things that I think is really important is that we're in a different macro regime. And the correlation structure that is underlying the concept of a 60/40 has been really challenged. And we do believe it'll be continued to be challenged because inflation is stickier. And actually, on the equity side, because concentration has increased, it increases the beta of your public equity portfolio.
So what role here, you started talking about how private markets play a really good role in the traditional way of rethinking the 60/40, if you will. How do model portfolios really help that happen at this juncture?
One of the things that's important for us is that our model portfolio franchise is built off of the institutional chassis within multi-asset solutions. So we manage just over $400 billion on behalf of clients across the globe. And that same investment framework is used to deliver portfolios to the retail space or the third-party wealth channel. And as it relates to alternatives, they've typically been excluded because of the complexity of alternatives. So when you think about J-curve management, or meaning how do you handle that you're not instantaneously ramping up on the private side, so you have to equitize on the public side to make sure you're exposed the way you want to be in a portfolio, or liquidity or capital calls. And now with the focus from the institutional community to build a proper vehicle that third-party wealth can access, whether it's evergreen vehicles or using more UMA construct within a model portfolio, you're able to give that access that only institutional clients used to be able to have to a broader retail franchise.
So you started to answer a question that I've been having. When we think about the wave of wealth that's moving into private markets, the big question is, can this really happen in an institutional manner? Can it really be that individual investors can get institutional style investment opportunities? To what extent are model portfolios helping that happen?
It's the same exact framework and governance that we use to build portfolios for a large corporate pension that we're using for our third-party wealth channel. And that's all the way from the strategic asset allocation to governance to access to certain managers. And even within those managers or building blocks, we have certain strategies that are, perhaps options-based or more focused on tail risk hedging, if you will. And we're allowing access now through our model portfolios to some of these typical institutional structures.
It sounds like the models themselves are allowing for a sense of scale.
Yes, they are. They're allowing for a sense of scale. They're also equally allowing for a level of customization. So just because you're on that institutional framework and heritage doesn't mean that you're not being thoughtful about your underlying clients and what their unique needs are. So things like tax optimization or having a laddered muni bond portfolio, you can still have all of that stuff without giving up and sacrificing on the quality of the underlying basis of the portfolio.
So when you think about the role of private markets in these portfolios, one question I have is how much will it actually help fuel adoption? Are there types of private assets that do work? Are there types that don't work?
So the total addressable market is definitely increasing because of the structures that are being launched. And I think some of the important part about, model portfolios is equally the education as it is delivering the investments. And in evergreen structures versus closed-end funds, there's pros and cons. You're constantly being invested. You don't really have to deal with capital calls. But in closed-end structure, there's also important things like the more diversification on vintage, a lot more opportunistic in terms of the alpha or what's happening in the marketplace. And so, the alpha, if you will, of the different vehicles might be different, but being able to give and deliver access either through interval funds or through these evergreen structures, you're able to gain that exposure in the model portfolio business and franchise that otherwise was closed off to those investors.
It's so interesting because liquidity is such a big question mark in private markets. A lot of these funds have a liquidity feature, but it seems to me the more we have these conversations around model portfolios, it's almost less confusing to a lot of people because it seems to me that the model portfolios are able to navigate those liquidity features better than if someone, say, were to just go off and do it themselves.
So liquidity is the beginning starting point of how we think about what does this client need and want. And so just like I talked about the 60/40 benchmark, part of how you get to that language of the benchmark is you think about what is the client's return profile and what is their liquidity need. And you can bake in that liquidity consideration on the public side equally as you can in the underlying vehicle itself. It's something that's paramount in our thought process and how we're building out the model portfolios for our clients.
So what does that look like in practice?
It's simply saying, okay, we have a client that perhaps, has a return profile need that's pretty high, but they may over this year have needs for liquidity, or they can't tolerate a large drawdown, which you obviously want to be able to on the private side, be able to handle different vol in markets. And it's saying, okay, then that means the portfolio that we're going to optimize and build to might have more front-end fixed income, if you will, or we'll hold more cash. And we'll think about having things like tail risk hedging in portfolios so you can smooth the P&L profile of the overall model.
So how much do you think about what the liquidity features in some of these private markets funds do in terms of what it means for model portfolio? So for example, if you need liquidity, how much do you kind of explain to clients, well, wait a minute, the private part is actually the part you don't touch. What are the liquidity features useful for those funds?
So the liquidity feature, even though it might be the part that you don't touch, you may still need to touch it, right? And so you want to have that baked in or part of the thought process. And we do a lot of due diligence on internal and external product to make sure that we understand the features that are available in the different vehicles that we're putting in our model portfolios. But there are other elements in the model itself where you might have traditional public access to liquidity, if you will. But it's important that the client understands what's in the portfolio, how it's being managed, the risks and returns that you can achieve by going out in the risk spectrum or in the illiquidity spectrum.
Now, let me flip a prior question on its head. I asked you what it meant for the private markets, but what does it mean for the wealth community to be able to access these models now that we're seeing more and more private market models, or at least public-private models being developed?
Well, you're getting access to an investment universe that you weren't, quite frankly, getting access to. Now, there's some correlations, obviously, and underlying themes and cyclicality across all of these markets. But companies are staying private for longer, so you're getting access to innovation and growth by being able to access the private markets. Private credit is now about 6% of GDP, so think like this is a very large universe of issuers that you want to be able to access. Some inflation hedging through the real estate and infrastructure. And so that's why in the beginning I mentioned you're getting some diversification benefits. Well, that's part of that spectrum of diversification, but also think about some of the themes in the market, whether it's AI or the power boom, all of these things have been very heavily funded within the private market space. So you don't want to close off those investment opportunities to your client base.
So what does this mean in terms of the types of strategies, actually, that your clients are flocking to the most? What is taking up the most of your time in conversation as you develop these models?
I would actually say tax optimization and tax alpha is the biggest consideration right now, especially because when we think about how we're going to allocate out alpha dollars, U.S. large cap has been a harder space for active management, but that active overlay, if you will, can come in the form of tax. And so at the end of the year, our clients are taking a look at their, portfolios and saying, wow, my direct indexing strategy added a lot to my portfolio, and just being thoughtful and considerate around, what's happening in the market, and then optimizing for tax considerations has been really creative to me in my portfolio. So, whether it's on the equity side or on the, muni portfolio, bond laddering, the ability to access and use UMAs in the model portfolio business has been extraordinarily creative to the clients.
And on the private side, too, what would you say in the next year or two? What are kind of new innovations that is going to make it more possible to make this really take off? Because the private side is the newer part of the modern portfolio.
It's newer in terms of accessibility, but obviously these are like deep asset classes. Some of the clients it depends again on the risk spectrum what they're focused on, but some are very heavily focused on growth and venture type strategies, want more private equity in the portfolio.
So very customized.
It's very customized, yeah. And I think that's one of the important parts. We have a alternatives building block, if you will, and you can build the model portfolio around that. And do you want more or less? And obviously the building block gives our best-in-class thinking on how we think you should asset allocate across them. But equally, you can, as an advisor, you can go in and you can customize this. And that's one of the reasons Goldman's here, and we built so much scale into our models business, is so that we can enable that customization at scale.
And I think that you would relate to this a lot, where the model business reminds me so much of what large institutions were calling OCIO, outsourced chief investment officer. People are handing you the keys, basically, and saying, help us make decisions across the whole portfolio, because I might only be seeing this part or that part.
So I do relate to that, because we have the number one OCIO institutional business in the United States. And the only nuance I would say is, like, we focus on, yes, they're handing you the keys, but as a partner, as a trusted thought partner, as an investment partner. And we take the responsibility very seriously, but equally it's, yes, this is our best in class thinking on how you should invest, but we want to also deliver the content and the content alpha to the clients and to the advisors, so that in periods of volatility where we don't believe you should be rebalancing your portfolio all the time and just reacting to the headline risk, that content is available to them to say, hey, this is how Goldman Sachs Asset Management is seeing the world right now.
Do you have any way you're looking at it in terms of the client engagement? Because I think a lot of people look at private markets and even model portfolios and say, okay, I want to put my money somewhere and just kind of forget about it. But it's really a matter of a lot of client interaction, a lot of client education, particularly in areas of the private markets. Do you find that there's a more active approach than people realize?
Yeah. Oh, yeah. We, in fact, we have a whole series of education, how to think about alternatives, and it's video, it's Goldman Sachs University, it's written content. We really pride ourselves on being the person to help not only see around the corner, but to explain what are these asset classes and what are the risks in investing them, but equally, what is the benefit?
And to go back to what you were saying at the very beginning, the markets are changing pretty rapidly. And how are these models serving the needs of those markets?
So we have a dynamic asset allocation process where we'll actively address opportunities that we're seeing, whether it's regionally, even, quality, momentum, different iterations. The fixed income market, the rate curve, obviously it hasn't been a sleepy place this year. But it's more than just the dynamic asset allocation. It's having active management, either through ETF vehicle or underlying mutual funds, as well as some passive products. So it's about every segment of the investment process delivering something that's able to add on top of what the fee structure is for the models business, and provide that return generation.
Alexandra, thank you so much for joining us here today. That is Alexandra Wilson-Elizondo. She's the Global Co-Head and Co-Chief Investment Officer for Multi-Asset Solutions at Goldman, and you've been watching our series on model portfolios, model behavior.